We have a handful of things to talk about today, and as per always though, I also want to make sure we set some time to take a look at whatever you guys have going on. So first things first, let's get out of the way, and I'm actually going to scoot myself a little further out of the way so that I am less dead center. The goal is to try to make it so that I'm not quite as much on the screen. Gotta say hello to everybody. So we got Charles, Tommy, Robert, Tom, LaBark, David, and Joey. Good to see all of the familiar names. And we're off to the races. So what's going on in the markets? A good question. There's a lot happening right now that I don't want to say it sticks out to me as anomalous because it's not quite that dramatic. But it's also movement that definitely registers as something that I feel like we need to pay closer attention to. And what I mean by that is if you look at something like the behavior of cryptocurrency, Bitcoin, for example, we spent some time talking about that actually yesterday during the market prep session. And it's because it's a really, really interesting space right now, especially with some of the valuations we're seeing. So let's take a look at what I'm talking about. If we look at, let's grab like a side by side. We'll do a pairs trade. And here, let's take a look at something like Bitcoin. We'll use BitO because a lot of people use that instead of the futures itself. And then let's take a look at MSTR. And then let's throw those here for us to take a quick look at. I guess I switched. And then let's throw MSTR. So there's a lot of people talking about the movement in Bitcoin, rightfully so. And Bitcoin today had a pretty massive move. And it actually started last night when we checked on the market prep session for the Outlier Pro folks. I typically will run through the futures to see what's going on, a little bit after the futures open on Sunday. And Bitcoin was up meaningfully last night. Now it's down a little bit. It's down 1.6%. But if we take a look at the move that Bitcoin's been having recently, it is significant. And that's obviously following through into the supporting products. So that's why you see something like BitO that's flying off the handle. Bitcoin, what did it do today? It ran from 66,491-ish, 66,400-ish, and it hit a high of 71. So absolutely massive movement. And I think when we're thinking about cryptocurrency and how that fits into a portfolio, we were talking about it yesterday in the terms of like, is it a store of value and all those kinds of things, which is a separate dialogue. But I specifically want to hone in on some of these relationships. And you can see that even though Bitcoin had a massive day, MSTR also had a wild day today. So really what I'm highlighting here is these are just very tradable movements right now. You can take a directional disposition if you're so inclined. If you were trading neutrally before the move today, you just got ran over because what an inside day MSTR had on the 22nd. But then if you look at the move today, it's, just insane move. And you can see that the realized move as of late has been running over the implied move. So that's a little bit of a tenuous position, at least as it sits now. But again, from the perspective of just being an options trader, we like volatility. And look at the volatility in something like MSTR right now. 190% vol for 3-day to expiration options. Massive. And obviously there's a lot riding on some stuff coming out this week because there's an immediate drop down into the 150s, which again, to be very clear, 150s is still very I don't want to call it inflated because it's very product specific. But if you look across products, this is high relative to other products. So again, let's just use an Apple example. So you were just looking at 140s to 160s. Something like Apple will give you something in the 20s in terms of vol. And you're thinking, okay, well, Apple's big, it's not doing much. Fine, let's take a look at Tesla. Tesla gives you something in the 50s. So I'm just trying to help create a bit of a scale and an appreciation for you guys on some of these things that we're looking at, because from a volatility trading perspective, you want vol. A lot of vol comes with some drawbacks. It's not as simple as, oh, just trade things that have high vol. The reason why it's not quite as simple as that is because it's very easy to get ran over. Remember, volatility is looking at expected move. So because of that, if we have a large expected move, we're getting compensated a little bit better, but not always enough to overwhelm the move that we receive. And you can see that that does happen. And again, like if you're trading vol, you're going to lose in those times. Like that is what it is. If we look at this earnings position here, or like this earnings cycle, notice how implied vol starts to dip down, realize vol skyrockets because it was a larger move than expected. So if you were trading just vol in this scenario, you would have lost. And some people, I don't know, they get too wrapped up in like just the prospect of losing and they forget that that's part of this fucking game. And it's really nothing to be wrapped around the axle about. Like we're all going to have losing positions. That is part of what we do as traders. The idea is to try to trade things that in general provide some sort of edge, ideally something that's structural like volatility. You can bake in other things as you're so inclined, but really the main thing is trying to create a solid thesis that's persistent in something that you can replicate over time. Bringing that all the way back to the example I'm giving you in MSTR, I think when you see vol that's going quite as crazy as this, it's very interesting. It's not as simple as vol is high, do a bunch of vol stuff in there, because you have to size very carefully and you have to get ready to realize the vol that's there. But I still put it on your guys' radar as something to think about because it is a tradable mechanism. So there's that. Tommy says, could you do a quick example of probability analysis of a strike in the money or out or touch using toss? Oh yeah, I think this is from earlier in the Discord. Happy to. So we can use MSTR. This is fine. Doesn't matter. So we can use the probability analysis tool. On the x-axis here, we have the days. So obviously the further out in time you go, the wider we expect this probability cone to be. That's all this is a probability cone. And as you can see right now, it's giving you a 1 standard deviation, 68.3% probability of whatever doing whatever around these. This is specifically for in the money. So let's say I'm looking at MSTR and I want to know what is the probability of us falling down to this point, 1605 or below. I want to know if it's going to close below that. Well, we can see the probabilistic outcome of that. Let's say you want to do a 30-day trade and you want to see what's the probability of it closing below 1605. Well, we go here to 30 days, we find 1605 on the y-axis, and that puts us somewhere right about, that's close enough, 44% chance of closing below. So what you'll notice is I said closing. This is also within a 1 standard deviation probability. That also messes people up. 68% of occurrences will fall inside this range. 68%. So what does that mean? There's still a lot of instances, 32%, that fall outside of this cone, either up or down extreme. So but this is for expiring in the money. So then we can look at the probability of a touch, which the probability of a touch is going to be higher. So going back to this same example, 1605, let's say that we have some sort of trigger that makes us do something when it's at 1605. If we come in here for that same 30-day trade and we look at, okay, 1605 is again, oh, I was right on it and I moved. Damn it, there it is, 77.6% chance. So if you have some sort of trigger predicated on this occurring, means it's very likely to occur based on current option pricing. Now, if you'll notice, this is not a standard distribution. They're not taking a standardized distribution, you can see that there's actually changes out in the distribution curve. So this can be leptokurtic, mesokurtic, it can have tails. It's using the IV for the options when it's making this. So Charles says probability of dirty math is 1.5 expected move for that time period, probability of touch. Probability of dirty math is 1.5 expected move for that time period. I have no idea what you mean. Expected move of what? Typo. Probability of touching is 1.5 expected. Yeah, but what is the expected move? Like, I'm not following what you're saying, because in this case, when we're looking at the probability of touch, like that is the expected move. So I think what you're trying to say is the probability of something expiring in the money. And that's also not fully accurate. It would be closer to 2 times. Charles says per expiration cycle. No, that's incorrect. So looking at the expiration cycles themselves, this is showing the volatility for that expiration cycle. That's actually what this other series is built off of. So if we look at all the different options chains using the vol itself, I think what you're confusing here is probability of in the money and probability out of the money. So probability of in the money is typically, probability of out of the money is typically about 2 times. It's not 1.5 times, it's closer to 2. And moreover than that, that only works up to a certain point. So people a lot of the times will use delta as an approximation for an option falling in the money at expiration. That doesn't hold true for things that are very volatile or as you go further out in time. Then you can take the probability of something expiring in the money, multiply that by 2 to get the probability of a touch. To your point, the dirty math, that's just an estimate. But again, that relationship breaks apart with things that are highly volatile or as you go further out in time. So yeah, not exactly on there, but the expected moves themselves are really interesting things to follow though. And but anyways, going back to the probability analysis, so that's essentially how you use it. And you can come up with different offsets if you're so inclined. So I typically don't like percent moves. Personally, I like to use standard deviations. So I will turn these into +1, -1, and then I'll at least add 2 more to get to 2 standard deviation. Once you get to 2 standard deviations, you have most of the data in a data set going to be encompassed there, about 95%. So you get the majority of occurrences that fall within that range. But yeah, this is essentially the way to use the tool. Now, the thing is you can change this to be a 1 standard deviation move. You can do it to be a 2 standard deviation move. And notice how it changes the curve. Because again, like if you want to be more certain that your data point is going to land in here, then you need to increase the standard deviations that you're willing to accept. But then obviously the probability of touches will change slightly. So that's what 2850 is 16.47%. So if you go back to this 2850, you'll see that it's exactly the same. So what I'm showing you is the probability cone is going to reflect whatever range you choose to have, but the probability for the point event itself will remain the same. Charles says, I've rarely found probability of touching is 2x expected move for that time period. I found it's closer to 1.5. Yeah, I mean, I would encourage you to research that more, not to like just shut it down. I will tell you right out of the gate that that's inaccurate. It's definitely product specific. So I wouldn't say that you would never find instances where the probability of a touch is 1.5 times, but that would be very much the rarity. That's not the rule. That would be the exception without a doubt. So yeah, it's definitely closer to 2%. It's not even really so much a conversation about it's literally the pricing of options almost demands it. Otherwise, a lot of things don't work if it actually resulted as you think it does there. So yeah, I would highly encourage you to check it out. But I mean, we can use something that's a little more normally priced in terms of vol, and we can test the theory right now. So if we go out just 25 days in Apple, we look at a 24 delta, that would expect, if we use delta as the approximation, that's about a 24% probability of being in the money at expiration. If we look at the actual probability of it being in the money, it's 26%, pretty damn close. And then if we were to multiply that by 2, again, I would expect that to be about 50%, and it's actually a little over 50% probability of a touch. So it's definitely not 1.5 times. It's like almost always wrapped around 2. Now, it gets squirrely as you go further out in time. So if we take a look at this 22 delta, 155, that would give us a 22% chance of being in the money at expiration. We come over here, it's actually 27%. And then if you multiply that by 2, you actually get almost like spot on 56% probability of a touch. So this is actually very close between the two probabilities here, much further apart for here though, because if you just multiplied your delta by 2, that would give you a 44% probability of a touch, and you would be off by 12 points, which is massive. The difference, again, delta, it can be used as an approximation. I have an entire video. I'll actually share it for you guys because it's a useful tool, but I also think it's really important for people to understand the differences between these calculations and why they exist, like why we can use delta as a back of the napkin, but also why it is not fully accurate. And then also how we're actively calculating the probability of things being in the money. That's all in that video that I just dropped in there for you guys. But yeah, anyways, the punchline, Charles, just to save you some time, is it's definitely not 1.5 times. There might be some minute instances where you'll find that, but it would be exceedingly rare that that's the case. Again, like looking out here at 361 days expiration, 30% probability of being in the money. This is calculating it as 37%. Multiply that by 2, 77.7%, like pretty damn close. So yeah. Anyways, Charles Ollinger, 2x expected move does not touch often. Again, I fear that you're kind of just saying things without having a data set to back it up. Again, like you can literally look at not even what I'm saying, which I've done a lot of homework on the expected move, obviously with trading options, but you can look at the platforms themselves that are pricing this with the options. And it's the case. I don't know. You can hang on to it if you want. You can disagree with it if you want. That's cool. But I am telling you, like, it's wrong. It's not accurate. The probability and like the outcome of a touch, it is what it is. Because if you think about the way that these probabilities are created, you can look at it in terms of a directional drift if you're so inclined. But really the more pure way to look at a probability of a touch would be, what's the probability of us moving out to this, one standard deviation, 162 put, but then also the one standard deviation call? What's the probability of touching one of those within the expiration cycle? And I actually think you would find that to be pretty damn close. So yeah, anyways, highly encourage you to check it out, maybe track it for a little bit, see what you come up with, but you will find that options are priced pretty damn well is what it boils down to. Labark says, following from my Discord chat earlier today, ratio call diagonal and CDLX has a short leg in the money. Talking with Joey as well, and it's too early to sell. And if I get assigned, I have a long call to cover the short. Yeah, a couple things. So one, if we look at CDLX, and I think if I find it in the Discord real quick, I think you told us which one it is. 25 days to expiration, so it's this one. And then strike is 1750. So of this 1750 strike, you still have a lot of extrinsic value. So the very first thing, Charles says, just like there's a column for probability of in the money, there is also one for probability touch each strike and toss. Yeah, that's what I was referring to that whole time. I don't know if you didn't hear me or something, but that's this column over here. So when I was telling you the probability of a touch, that's this one. And then when I was referencing the probability, or I'm sorry, the probability of in the money, that's this one. And then probability of touch is this one. So yeah, definitely. Going back though to LeBarc. So the 17.5s, they have a lot of extrinsic value left. So the probability of early assignment here is very low. And the other thing is the probability of early assignment, it doesn't pay a dividend, decreases it also quite a bit, because early assignment leaves money on the table is what it boils down to. If I choose to exercise this option early, that's 75 cents of extrinsic value I could have recouped. So it doesn't really make sense to do that. Sometimes it does make sense if there's a dividend, but it doesn't make sense if there's not a dividend. They're kind of just leaving money on the table. Charles says 50% probability of touching would be upside or downside. Isn't that the range? I don't follow your question. So the probability of touch when we're looking at one of these is looking at the probability of this specific option being touched. So like in this example, if we look at the 22.5, this one, it is a 65% chance of being touched. And then in this example over here, this has a 95% probability of being touched. So when we're looking at the probability of a touch for the individual options, it's obviously pricing it indifferent to any sort of price movement, and it's using the current option pricing to determine specifically vol where it could go. That's why this is all simply within one standard deviation. So again, there's a large sample of data, over 30%, that will fall outside of the probability of touch, meaning it would exceed this. So when we're referencing volatility in general and then volatility derivatives in calculations, stuff like this, probability of touch, volatility in and of itself is also looking at a certain size move over certain periods, and it's with a one standard deviation confidence interval. So things can move outside of them regularly, but yeah, it's expected range would be the 50% touch strike to upside or downside. Yeah, so that again, that would be, yeah, that's not, at least in the reference here, this is looking at this specific option. So it's not the range, it's looking at the specific option. Now, when we look in the probability tool and we look at the probability of a touch here, this is also for that specific price level. So in this case, if we're looking at the probability of a touch for the 30 handle, it's a 9.12% probability of a touch. And that's for a 20-day option, something like that. And that's using current option pricing. And then if we look at the probability of it being in the money, what I say for that, did I say 20 handle or 30 handle? I already forgot. I think I said 30, 20 days. Yeah, 30 handle, 20 days, 9.2%. In the money, 20 days, 30 handle, 4.42%. Literally almost exactly 2 times. So yeah, again, that is kind of the cool part about options, is that they're priced pretty effectively. And it actually makes things, I think, easier when it comes to like trading options. A lot of times people will get wrapped up about things like, oh, like what delta is the best, or they'll kind of get stuck on different aspects, and they'll forget that if you're using something like delta, or if you're using something like probability of touches, like it's agnostic to all the noise, and all of this different kind of calculations or permutations are very much baked in to the option pricing, which is, again, it makes trading options a little easier. Realistically, I really am a pretty firm believer that if you could trade options pretty successfully without ever looking at a chart, I think it definitely kneecaps you. There's no reason to do that. There are a lot of other ways you can trade options that using a chart helps a lot. Specifically, if I'm trading some sort of leverage directional strategy and I'm trying to assess momentum, I absolutely want a chart. You're not going to see that in options, again, because the options pricing are agnostic to that. They might capture some element of it, but not any what I would consider to be more of the forecasting potential of a chart. Give and take, as you probably would surmise, but a lot of things you really don't need a chart. Like if you're selling options, really a chart doesn't matter. If you're selling options, looking at a chart might help if you're going to set some sort of stop relative to where you think price may or may not go. But in that instance, that doesn't really matter so much anyways, because typically if you're selling an option, you want to mess with it as little as possible. There's always exceptions to all of that stuff, but in general, that's the idea. Labark says, Charles says, will you be selling strangles on Reddit? Yeah, I actually was going to talk about that. And I have a covered strangle on in Reddit right now. If we take a look at the position, so the remaining, I already gave you guys a little bit of a preamble of the position. So I still have a remaining position after I sold a bunch of it on same day when I first started trading it back here on the 21st. I offloaded a good bit of it. I think at like, I don't remember. Yeah, I don't remember. It was somewhere above like 55-ish, something like that. And so I kept about a third of the position on. So that's what I'm dealing with now. And the position that I have on at the time, right now, the basis is 54.85. So it's not a great basis. It obviously was done a solid today because Reddit chose to move literally 30% in a day. But that ended up being pretty solid, to be honest, of a move. But yeah, so I have the 50 puts expiring 19 April, and then I have the 65 calls expiring 19 April. And I originally sold those 65 calls. Both of these, this is actually a really fascinating case study, because if we take a look at the 25 April chain, this is wild. When I first sold these 50 puts, they were trading for $5.60. I sold them early in the day before this giant move. And literally, the volatility expanded so much in the options that a 30%, is probably a little less than 30% that I would have sold them. I don't remember the exact time that I entered the trade. But what ended up happening is literally, let's call it a 20% move. I'm losing money. I'm right now underwater on my short puts that I got a 20% accommodating move, give or take. And it's literally because volatility expanded so much. Insane. And obviously on the 65s, I'm getting murdered because I sold those for $4.15. So what ended up happening is earlier in the day, I offered the 50s and the 65s. And Charles says that sucks due to the vol expansion. Yeah, it's wild. I mean, it really doesn't suck at all. It makes no difference to me because it's a covered strangle. I like the way I manage this, it's baked in. So all of it's going to fade out no matter what. But it's just so interesting to see that kind of massive movement, in which specifically on the put side, I had a massive price accommodation and it still didn't matter at all because of how much volatility ran out. So yeah, this was really interesting. Now, this trade would have been this would be a very tough position to trade like this, unless you had really, really careful control over the product, or unless you're running something like I am right now, like a covered strangle, because to trade naked vol in here is not something I would do. It's just too sketchy as it sits. I think, oh yeah, that's also kind of really cool. Notice how there's no open interest on any of these yet. And it's because options just started trading today. So tomorrow you'll see all of this volume rotate over to the open interest. You don't really get to see that too much. So figured I'd call that out as well. Charles says probably needs a week or two to level out and weeklies. Oh yeah. I mean, IPOs, especially for the first month, they're wild. And this is exactly why, you know, I was talking to you guys about this a lot last week, right? When I was saying this is quite very much a do as I say, not as I do sort of trade, especially, you know, depending on what your dispositions are. Just trading IPOs it's wild. It's the Wild West. Things are going all over the place. People are trying to decide what something's worth. It's an absolute crapshoot. Mr. Live for Him says, so you have 100 shares, sold covered call and sold put. Yeah, so I have more than 100 shares, but to your point, that's part of the covered strangle is having at least 100 shares. And then I have an uncovered call against it and a series of short puts. Yeah. Tommy says, I prefer shitcoins over IPOs. Yeah, I mean, whatever works for you, man. There's a 0% chance that I would make that same movement myself, but I'm also primarily a stock market trader. So I have a bit of depth in something like this anyways. So yeah. Now, speaking of depth though, and well, let's see, there's a couple of things I want to talk about. Oh yeah. So on this Wednesday, the video for this Wednesday is a Outlier podcast interview I did with David Peer. He's the Marine vet from Military to Millionaire. So he's kind of like a real estate flavor. So that was actually a really fun conversation. I kept that conversation very practical focused for you guys. So I was asking him things like, how does he go about finding deals? What are some of his favorite financing approaches? Because one of the things you'll find if you're in real estate longer is you start to try to get more creative with the way that you finance deals, especially if you're working with limited capital. If you have a lot of capital, honestly, you could still be thrifty for the sake of leverage and whatnot, but it's definitely less of a thing to be worried about. So anyways, that comes out Wednesday. We talked about MSTR already. We talked about Reddit a bit. TQQ's interesting pattern right now. That's the one thing I wanted to highlight in TQQ's. Check us out. We going sideways. So we're very much starting what I would consider to be a basing section. Now, again, to be very, very clear, this is using a 3 times levered product. So I do not hold technical analysis into the same regard here. I think it's much better to conduct your analysis on the standard underlying itself. It'll just be a little less extreme in terms of its movements, obviously. And this is what it's based off of. Now, notice a couple things though, that we have the point of control in TQQs on a 6-month daily is down here at 35. Notice where it is on the Qs. That's a big difference. So I like to base most of the technical movements off of the base product itself, in this case Qs, but I'm not going to not look at the other as well for stuff like that, because that matters. The fact that the point of control on TQQs is like all the way down here, whereas something like the Qs, it's pretty much right where we're trading. That's a difference. That is something you have to be aware of, especially as you're analyzing the products. So I still think tech is holding its own. If we take a look at the sectors real fast, drag this over here, and I am apparently lying out of my teeth. Because on today, it's down 0.5%. I mean, obviously, I'm partially joking. It doesn't really matter. It's essentially kind of just trading, though, starting to consolidate. On a 5-day period, IT is still up. Not up all the way, but still up. Like number 4. I feel like there's no 4th place trophy, so I wouldn't consider that anything. And then 1 month, it's like middle of the pack. 3 month running at the top, 6 month, and so on. So what does that mean for tech? Well, I think for tech in general, we're still seeing things like NVIDIA, and it's still climbing. So I actually have to update my stop, as you can see. Wow, I really have to update my stop. It's been a while. What do you guys think? Stop move up to like 8.25? That's what I think. Slide that bad boy up. And we'll keep trend following this thing until it breaks the bank. NVIDIA has been absolutely on a tear. And I mean, I really like hearing the conversations people have about like how high can something like this go, because I feel like people forget, like people have like really short-term memories sometimes when it comes to markets. And I think it's to their detriment to a pretty big way, because like, let's take a look at something like Amazon. From a, split adjusted basis, it has gone from 7 pennies to 179. That's a pretty big move. I actually don't know what the return is on that. Do you guys, let's see, I can do the math real quick. So 7 pennies to 179.71. Holy shit. It's a big old return. I literally have to click into it because I have the numbers too small. So it's the 256,628.57% return for those wondering at home. A good old 256,000 bagger. The point I'm making is people look at something like NVIDIA and they think, how on earth could it go anywhere higher? It's insanely high as it is. And it is. But what I'm highlighting is over different time frames, products can grow wings. And you have to figure out like how you want to trade stuff like this. Like, for example, if I was building some sort of long-term thematic position in AI, I don't think it's impossible, but it's a way higher risk entry. Like, we're very late to the game. And the later you are to the game, the higher risk your entry is going to be. That's the trade-off. But it doesn't mean that something can't continue to go up. So, I mean, if we look at a 3-month basis, look at the point of control. Like, people have been transacting in here at 891 a ton, literally a ton. And let's actually see what it is on a 6-month. 6-month way down here. That's actually fascinating how big of a difference that is. But way down here. I think we can get rid of these for you guys, just kind of clear out some of the noise. But that's incredibly impressive. The point of control on a 6-month basis is like 495. And then as we zoom into a 3-month basis, it's literally 891. That means that there are just people piling into this. And you can see it represented in the volume. Actually, let's zoom this out to like a year. Look at the average volume slope. Even from here back at the beginning of the year, average volume here was like 47. And now average volume is almost 80. Like, just massive movement. Absolutely massive. Lots of interest, rightfully so. DeJohn says, do you trade any sectors? Yeah, I definitely trade sectors. I rotate in and out of them all the time. I still have kind of like a standard monthly rotation strategy that I do. That one, I mean, it's positive edge, but it's not anything to write home about, and it's capital intensive to not necessarily get giant moves, but it is what it is. Beggars can't be choosers. But then I also typically will trade like the leading sectors, or if I'm inclined to trade like the winners within the leading sectors. So like right now, that's kind of part of the TQQQ's position that is very much a technology sector leveraged play. But I also traded utilities and materials. I've been talking about them a lot, and it's specifically because they've been kind of turning around. I have to keep a close eye on them because there's definitely stalling here. So something like utilities, I am still trading, but monitoring profits. Energy has also been on a tear, so I'm maintaining the position I have in here for now. I actually think this can go away. This is kind of irrelevant now. And then materials is a little more boring, but same, closer to what you saw from utilities. So yeah, mostly just trend following where I see a bit of a rotation going on, but there's nothing really to write home about in any of these realistically. Tech, and specifically individual tech, I think that's where a lot of the movement is. Labark says, what position do you have with NVIDIA? I have a ratio call diagonal. Charles says, would you ever start playing reversion to the mean, something like NVIDIA, by just selling calls? No, I think it's fucking stupid, which is funny because when I was talking to Tom Sosnoff last time, he was saying how he was short NVIDIA back at like 5 or something like that. And it's just a wild position to me. His perspective obviously is different. He's there to like fade everything. That's kind of his general go-to. But yeah, for me, I consider myself a little more discerning, because I tell you guys this all the time, man. Like, fucking stack strength. That's the way I think about it. Like, there's no reason to get cute with things until you see it start doing what you want it to do. So, like, let's say if I wanted to fade NVIDIA, and again, hindsight being 2020, but if you see like these 2 down days and then this 3rd day below, like, this is where I would at least try to fade it if I had some sort of strong downside disposition. But then my stop is set like right there at 727, something like that. So like, I would have ran over on this anyways, because I probably wouldn't have adjusted the stop here on 678 unless I had like a really strong preference for it or whatever. Maybe resistance for the downside would have been here at like 660. But yeah, the point being is it's playing the game on hard mode. I'm not really interested in that. So yeah, not for me. I think playing reversion in something like this is silly. I think you trade the direction that it's going. I think it's been literally running between +1 and +2 linear regression channels for weeks now. It started back on the 4th of March. Hey, that was my birthday. Happy birthday me then. And yeah, it's just been running around up there. So yeah, no way for me. Tom says, what do you think about Lulu post earnings? Looks gross. Yeah. I don't love it. That's a big drop, man. Wow, and they made a lot of money. What's the issue? What didn't they like? A lot of $5. Issued Q1 guidance below estimates. Crazy. $38 trades to the downside. Yeah. Price cuts, target cuts from analysts. Yeah. I want to see what they say. Shares of Lululemon fell around 16% during Friday's session after releasing 4th quarter results. Damn. It's a big down move. I mean, really the only thing I would be doing in something like this right now would be vol. Yeah, it would just be vol of some sort. So the benefit to drops like this is typically, to me, that would indicate that some of the downside has been taken out of it. So I would probably go with something like a strangle. I wouldn't want to just sell puts in here because it's obviously going down, right? So if we go back to the basics of at least the way that I think about trading, if I sell puts, that means I want it to go up. Although I want to sell puts because there's a lot of put skew right now. And obviously the thesis would be that the downside is starting to come out of it. So I would sell puts, but it would be via a strangle of some sort. It wouldn't just be puts. I think puts here would be silly by themselves. We look at like the 365s. Yeah, something around like 1 standard deviation. I think is okay. And the vol there is like 28% vol for a 17 delta. And then for like a 16 delta to the upside, those are 29% vol. So there's literally call skew in terms of vol right now, which is interesting. Let me see if I can find like a same delta. I'm actually curious what it is specifically. 27 delta, 27.63 vol, 28.11 vol. So literally there's vol skew on the call side. Very interesting. The other thing I'm actually a little surprised is like premiums aren't exactly where I would expect them to be, especially for like the one standard deviation, like 16 deltas, but for like closer, they start to get more interesting. So maybe a little more aggressive going to something like a 20 delta. I think a 30 delta is a little too close for me right now. Let's see, 375. Yeah, I mean, it's okay. Let's see. Let's take a look at the probability. So I was looking at a 25-day trade. Let's take a look at 375. Probability of that being in the money is 32%. So it's actually a little elevated. And the probability of a touch on the 375, 65% chance. So yeah, it's a little much for me. I'd probably scoot a little further out personally. But then this would be something I would manage risk to both sides, to the downside and the upside. To the upside, I would be less concerned, to be honest. To the upside, it's something where I would just probably roll the short calls a couple times and see if I can get out at a profit. But to the downside, if it starts picking up any sort of velocity, then that can go for a little while. My guess is that it would start to consolidate a little bit. Like these are two big down days and we're getting closer to the point of control. So my guess is the market will start digesting this a little bit. But this is like what I would see the next stop for it to the downside, like 378, because that's really just the next node that we see. Paul says, do you think SPY is close to a correction? The fuck? The SPY is up like 10% on the year. The fuck do you mean close to a correction? I think it's nowhere near a correction. Yeah. I think that doesn't mean that it's not like eligible for one. Everything's always eligible for one. But again, like think about it. If we're betting people as we are, do we think that the probability of SPY going up or down from here, like which one would be greater out of those? I mean, to me, it would be up unless there's something that changes that narrative, meaning there's new information injected into the market that then subsequently causes a down move. But yeah, I mean, it's just going up. And for those that don't know, something like a Charles says, market's designed to go up with positive drift, might as well be on the right side. Yeah. And I mean, to Paulo's point, which I get, sometimes you can see something that's like slightly overextended, but again, like a pullback, in my opinion, it's important to differentiate between like a pullback and a correction. A pullback, something normal, like 3 to 6%, like shit has to move both directions. That's very normal for markets. But like once you start getting into like a correction, which is at least a 10% pullback, now there's something materially that's changed under the surface to cause like that big of a move. Again, not that 10% is massive. It's nothing too crazy, but still that's noteworthy. That's why we have a different term for it, right? A correction versus something simpler like a pullback. So yeah, I think unless there's new information coming out that would lead me to change my disposition, as of right now, I see nothing that would indicate that SPY would be coming into a correction. That's, to me, an example, again, like where traders try to get too cute. We try to like front run things thinking like, oh, this has gone up so much for so long, it's got to come down. Again, like if you took that position starting anywhere back from the 30th of October of last year, like you've just been getting ran the fuck over the whole time. Same thing like what you're seeing in NVIDIA. So the overall disposition I take to stuff like that is trade the direction it's going. Again, does that mean that it couldn't pull back 10%? Absolutely can. But in my opinion, it would need some sort of catalyst to do so. It wouldn't just do it because it's gone up too much. I think you would have to have something that would get people to be a little bit more nervous to start going risk off, especially if we overlay a little bit of macro in the conversation and we think about stuff like the rate and the recent FOMC statement. I think overall that was pretty bullish for stocks. So Charles says, thoughts on cheap out of the money put butterflies on SPY? Not for me. Yeah, that's definitely not be for me. Joey says, would taking profits not be a reason? It depends on the scale of taking profits, right? Like if we have some entities that choose to take profits, then sure. But it would take, SPY is massive. It's a absolutely massive product. So I actually don't know what the latest market cap is on it, but we could do the math real quick. So it's 856,432,000. So 856,432,000 shares times, let's be precise. So we'll do 519.77 at the latest close. We're going to have to turn this thing sideways. 445,147,660,640 is the market cap. So 4.45 billion. So in order for this to start going down in a meaningful way due to people taking profits, you would absolutely need to see like significant selling. So the other thing to keep in mind is, unlike traders, institutions who are the primary holders of products like this, they move slower than us. They're not like jumping at each turn of the coin or flip of the coin or whatever, trying to make more movements. A lot of them, they have much longer term thematic positions that they're not looking to adjust that regularly. So again, to your point, people taking profits absolutely could cause a pullback. It could even cause a correction if there's enough of it. But what I'm highlighting is the scale required to get there is pretty massive. So for people to be that interested in taking profits, it goes back to kind of my original point of, in my opinion, there would need to be some sort of catalyst for them to want to take profits that bad to start unwinding, because it would have to be pretty broad scale. Paul says, give some of it back. I mean, yeah. And I mean, to your point, like it's already given some of it back, right? Like it hit a high of 524 and now it's down to 519. So markets absolutely move in two directions. I just think the concept of a correction, again, it's a specific term. So if the question is, do I think SPY will come down slightly? Absolutely. SPY has to oscillate just like everything else as price is digested. But again, like I definitely don't think there's a correction on the horizon just yet. Again, there could be information tomorrow that makes me pivot 180 degrees. That's the nature of trading. Loose, strong convictions loosely held. Until there's new information, I go off of what I know now, but new information can cause me literally to pivot 180 degrees. If, for example, the war in Ukraine started to expand massively and NATO is going to get involved, well, okay, that actually would materially change my disposition towards markets, but it takes those kinds of events to cause that kind of change. Charles says, what qualifies a market correction? It's a 10%. So 10% from recent highs. Now, people do debate over what we consider a recent high and how far back does that go. But typically speaking, you would hear it in the context of the last 52 weeks. So for example, if we hit this high of 524 and we drop 10% from that, which would be a 52-point drop, then we would consider that a correction. The other thing that starts to get squirrely for some people with respect to corrections is it also, some people want to see a sustained move. So for example, if you look at the COVID bear market, I think the primary reason people, well, a lot of people had interesting thoughts about that bear market is because, if I'm not mistaken, it was like 3 days long. So most bear markets are like 298 days with persistent weakness, like that kind of stuff. So there are always anomalies to all of these different kinds of things. But yeah, For a simple answer on a correction, it's typically 10% pullback from 52-week period. Yeah. What else you guys got? We're just about at an hour. So if you have anything else, I'd love to hit it. Oh yeah, in the meantime, residential sales came down hard body, was not good. It was expected at 0.675 million units, and it came in at 0.66 million units. And the previous was 0.661. So it's slightly higher than previous, but definitely not regaining traction as much as they thought. And more interestingly still, is new home sales was expected at 2.1%, and it came in at negative 0.3%. So yeah, it was a pretty big difference than what we saw on home sales, which there's a lot to try to read into there. I haven't looked at like the more recent home default rates and stuff like that. I'm not expecting that to be anything significant. Wow, look at this. New residential construction is up massive. 10.7%. Wow. Retailers up 4.4 billion. Manufacturers down 30 billion. Interesting. Very interesting. Look at this. January, new construction was down 12%. Now it's up 10%. Carl says 7% interest rate sucks for sure. Yeah, I mean, I don't know, man. I think people are too wrapped around the axle about that. One, mortgages tend to move around. Two, the Fed has made it pretty clear that they're targeting a much lower federal funds rate, which will inevitably at some point bring down rates. Three, right now, if you look at the relationship between rates and home prices, they're not quite where we would expect it to be based on that. But what I try to explain to people is, if you think about interest rates, they're adjustable. You can always refinance. You can't refinance the basis of your house. So to me, I would rather have a slightly higher interest rate environment where houses are slightly depressed so I can get in at a slightly better basis, deal with the higher interest rate for a year or two, and then just refi and then get a better rate. That's exactly what I would do. So I wouldn't let high rates be a massive problem. The issue, at least for millennials, my generation, is I think a lot of them have very, very skewed expectations of where they would like to be by this point in their lives. Most of them are now just getting out of debt. They're now just trying to get into their first house, and they have some aspirations about what they want their first house to be like. So they have to start making concessions. Either you move somewhere else, you downsize the house that you want, but like a lot of people are complaining about all different parts of the environment. And I agree, like it's not easy now for sure. But I still think that it's like 7% rates, not fun, but it's a short-term thing. We know that rates are going to come down at least once this year priced in. They're talking about 3 times, and that's what's priced in right now. And it'll continue down over the next couple of years, provided that the economy behaves as is. The other thing I would offer to those kinds of people is, if you can get into something at a 7% rate, then your worst case scenario is then realized. And then as rates go down, you can obviously get yourself out of it. But as long as you don't stretch yourself too far trying to get in at a 7% rate, because you are going to have to, make some calculated decisions based on how much house you want and what the basis is. But like you have room to move if rates go down. If rates go up, then as long as you position yourself to a point where you can continue surviving for the near term, then, it is what it is. Housing is expensive, but yeah. But Bark says lots of chatter around the whole commission setting for realtors. Yeah, I think that that is a fascinating turn of events. And I also think what Charles just said is also probably on the horizon. I'm not even sure if it needs to be AI, like just an online marketplace. And you see places like Redfin already starting to do this. So I absolutely think in the near term, those kinds of things will absolutely start to shift a bit. Charles says realtor is a glorified tour guide. To a degree, I would agree with you. Obviously, if you have a good realtor, they should be really helping you identify areas that you're interested in, shorting that curve. That's not to say that you couldn't find the house on your own. You absolutely could. But it's like the same thing that people are part of, you know, my Patreon or people that pay for courses. You can find everything that you would want to know for free now. The name of the game, though, is finding places to spend capital to accelerate whatever outcome it is that you're looking for. And a realtor definitely could do that. Like right now, I'm at a position where if I wanted to transact without a realtor, I could, but I still probably would use a realtor. And it's because they still offer at least enough value for me. Now, I will tell you that 6% is not happening. Anytime that I've done a transaction with a realtor, we've negotiated down from that because that's crazy. But beyond that, I still think that they definitely add value. But for people trying to, you know, do things on the cheap, I mean, you just go on Redfin. It's like fucking buying something off of Amazon, except it's just a house and then you grab it, which is, again, just a really interesting turn of events. And to your point, Charles, like I just see that continuing. So Joey says we did auction and only paid 3.5% commission. Yeah, there you go. See, that's exactly right. You find stuff like that and you save yourself some decent money. All right, you guys, dinner time for me. Don't forget to like the video, subscribe to the channel with all of you, I think should be, and please share. The more people we can get out hanging out with us, the better it is always. I enjoy connecting with you all. I'll catch you guys in the Discord. Be an outlier. I'll see you guys later.